All right. Hi, everyone. Thank you all for joining us today for the very first webinar in Qualia's Executive Perspective series. And in the series, what we'll do is speak with veterans in the industry about market trends, business positioning, and their perspectives on a range of topics, including growth, customer experience, technology, and more. And we'll have the opportunity to hear directly from those industry leaders to gain insight from all of their experience and expertise. So I'm here today with Mike Rubin to kick off the series. Hey, Mike.
Hey, Max.
And I'm really excited because Mike was one of the first people who I met in the title industry, and I'm sure many of our listeners know him as well. And he's been in a variety of roles in the industry, spanning both title companies and underwriters, and just generally very active and at the industry events. And we just saw each other at the NS3 conference. It was good seeing you there, Mike.
Great seeing you.
Thanks. And he has the National Title Professional designation from the American Land Title Association. And for the past 2 years, he's been with Shaddock National Holdings in the role of president. So he just has a wealth of knowledge that we can dive into today. So Mike, thanks for joining me.
Thank you, Max. I'm really excited to be here.
Good to hear. And before we dive in, just a quick logistical note for the attendees. If you have any questions during the discussion today, please submit those in the questions pane. And we have a lot of attendees, so we may not get to all of them, but we'll follow up with you directly if your question isn't answered. But with that said, Mike, to kick things off, can you give our listeners here today some background on Shaddock and your role at the company?
Sure, I really appreciate it. And first of all, let me say thank you for having me on. It's really exciting, and I think this is going to be a really great series, filled with some really interesting conversation. We'll see if I'm interesting or not. So Shaddock is principally Bill Shaddock, who's owner of Capital Title with Texas, which is a very large agency in Texas, more than 100 offices, about 1,000 employees or so. Also owner of First National Title, which is the 9th largest underwriter in the country. He was looking for an expansion vehicle for growth outside of Texas. So in discussions with me, we decided to kick this off and created Shaddock National Holdings. And we've been mainly acquiring, doing M&A work around the country, really from Seattle, Arizona, Las Vegas, all the way through to Florida, speckled in between.
Excellent. Yeah, it sounds like there's been a lot of expansion since you joined the company, and definitely have a great experience to draw from there, given your past roles. So I'm sure that's been helpful during all the changes that we've seen over the past 2 years with the global pandemic and all of the uncertainty that initially caused. But then we saw volumes, going through the roof right as you're expanding the company as well. So while that was happening, it's always difficult to predict what's going to occur next in the real estate market. But we knew that those record-breaking volumes would eventually turn back to a down cycle. So as you look back at those last 2 years from an operational and just general business perspective, how did you and Shaddock approach those record volumes while also keeping an eye towards that slowdown that could be on the horizon and that we're seeing now?
It's been a crazy couple of years, hasn't it? It was interesting. We started out Shaddock National Holdings effectively October of 2019, and then 4 or 5 months later, the world shuts down for a pandemic. And we're questioning every financial model that we built in the previous 5 months and kind of what our plan was going to be. And then, of course, we all witnessed kind of an epic slowdown for 6 weeks, and then the rocket took off, and away we went. What we decided to do at Shaddock National Holdings was effectively we understood that we kind of missed the refi market. That we didn't have a refi platform. We didn't have a lot of national relationships built there. So we stayed away from that marketplace really, by and large, and focused on major metro market residential resale and commercial acquisitions. That left us in a place where we watching this refi volume and saying, boy, we really wish we had a good platform in place for that right now. Now it's I will claim that it was all part of the plan, but it really wasn't. We really wish that we had that in place beforehand. That said, we're sitting in a good position now. Our growth plan that we implemented of major metro market acquisitions really has left us in a good position going forward.
Good to hear. And during the pandemic, that market change, exposed a lot of opportunities for real estate transactions, and I think it really accelerated conversations around the role of technology as well, not just from a siloed business approach, but really industry-wide, looking at how we can all improve the experience. So as you added those companies into the Shaddock family, how did that change influence your perspective when it came to your current and future technology investments at the company?
So I view us more as a cooperative of title companies than a top-down organizational structure. When we acquire a large company in a major metro market, we leave its functional technology in place, and we just try to add to it where we can and say, okay, have you seen this vendor? Have you seen that? What are you doing for wire fraud? What are you doing for your notary management? Let's talk about different platforms that may fit your operating system and fit the way that you run your company. And by the way, it may have a positive impact on the P&L that helps everybody. So we try and grow that way. What I will say about technology is it's been amazing to watch the vendor space explode over these last couple of years. Think back, I don't know how many RON closings many of our listeners had done in pre-March 2020. For me, it was, and for our companies, you could probably count them on two hands how many we had done at that point. And now we're doing that daily, if not a lot more than that across the board. I will say that I was actually kind of enlightened a couple of weeks ago, going to NS3 and walking the vendor space. 30% of the vendors I had never heard of, and honestly, I'm barely plugged into the industry and the space, but the vendors are there generally to help you with your business and save you money. Knowing the vendors that exist in your space, seeing what technologies you can implement that will save you time, that will increase productivity, and that will ultimately increase the bottom line are things that all of us should be doing at this point.
Right, absolutely. And when you work with companies in the Shaddock umbrella, and as you bring new companies in, it sounds like you kind of take a consultative approach when it comes to helping those companies with technology. Do you think that's an accurate characterization there?
Yeah, 100%. We are not top down with everything except for potentially security, information security. We do take very seriously. We employ not one but two CISOs, two different levels. So we are very well protected, if you will, there. But honestly, the hit rate of fraudsters trying to hit us from every different angle has increased so much over the last couple of years. Fraudsters did not take off the pandemic, so we definitely try to be proactive in that space. That's about the only thing that we push down, if you will, technology-wise. Everything else is pretty much what best fits your organization, and let's consultatively look at that and approach it.
Right. And you mentioned Ron. It's definitely interesting to see. There was a small amount of transactions before the pandemic. Interest certainly picked up when it started, and saw transactions growing, but still relatively low volumes. And then now, I think even since offices are back open again, and you see a lot more in-person closings, those are fine to do again. You still see this nice growth in RON transactions, just because we're starting from kind of a low volume, and the industry's been picking those up a lot more. So do you see a particular interest on, fully digital closings or hybrid closings, or are there particular topics there that seem to be top of mind for the companies that you've been working with?
Yeah, fully digital closings are entering the space, or have entered the space, honestly. If you talk to some of the larger national companies that have been do heavy refi volume, They sound like they're light years ahead of me and our companies at this stage. They're servicing a different pipeline of business, and they're using technology in really incredible ways. And honestly, I can't wait for it to filter all the way down the chain to residential resale in a real meaningful way, where we're not still kind of learning it on the fly. But again, we're doing these types of transactions, just not quite as often as some of those big national operations are. And it is local, it is lender driven. Think about the way title companies interact with lenders and with regulatory agencies and government. We do a darn good job as an industry of following instructions. we get a closing package and there's 25 pages of instructions, and we dutifully follow those instructions on every transaction. When a lender wants something, we figure it out. So we will figure this out, and I can't wait until we are in a fully more digital space.
That's a good way to put it, and it'll be exciting to watch the progression there. But want to shift gears a little bit here and talk about Shaddock's M&A portfolio. And as we've talked about, you're very active over the past 2 years, along with many other entities who are getting into title M&A due to just the favorable cash flow characteristics that the title companies have and the good businesses they represent. So for you and Shaddock, what were you looking for in title companies during that time, and how has that shifted at all in today's climate, if it has?
Yeah, so it honestly hasn't shifted at all. So I'll say that much. We focus, like I said before, on major metro market, large, stable acquisitions. Companies that have been in business for 10 years or more, have 10+ million dollars top line revenue, that have 50+ employees, sometimes many more, and that have really good reputations locally. I joke with Bill that when we kind of came up with the kind of company that we were going to be, I said, don't picture us as a top-down brand. We're not rebranding as Shaddock National Title. We're not doing anything like that. We represent more of a NASCAR approach in that we may sponsor the vehicle, but the vehicle will be plastered with the logos of all the different companies we essentially represent. And that is something that honestly has been, I think, attractive to the title agency owners that we've spoken to. The model will at some point progress, and has progressed in some markets to smaller acquisitions underneath those entities. What major metro market roll-ups, things like that, that help strengthen those local brands and take advantage of the economies of scale that we represent in those marketplaces. But really, that approach is holding true. The only thing that's changing is there's seemingly a lot more interest in the space from potential sellers. My 12-year-old daughter would say that my DMs are blowing up.
Yeah, I really like the NASCAR, the race car analogy, and particularly, like you said, real estate is local, so those local brands really matter in those types of markets and in a purchase environment. And what do you think is driving that increased interest from sellers the most right now?
Change is hard, and change is sometimes frightening. And we've been through some really great times. A lot of agency owners that we talk with are saying, I don't know when we're going to have that kind of record profits. We've done really great. We've put a lot of money in the bank, and now maybe it's time to take some chips off the table and look for either an equity partner or look for a long-term game plan for transition here. And a lot of these companies, they've got owners who have got 3, 5, 7 years left before they want to retire. That's the optimal time to sell. You're going to get top dollar as an agency seller if you are willing to stay on for a long period of time after the transition to help run the organization, keep it going, adjust as the markets adjust. But you look forward over the next, it's hard to predict out 5, really hard to predict out 7 in this industry. I'm lucky if I could predict out 6 weeks. But over the next 3 years, it's hard to say we're going to be back to the kinds of profits we had last year. I think we can all say that. So if you right now are holding a a title agency and saying, I may have to have some layoffs next year. Interest rates are rising. Maybe now is the time for some deeper pockets to come along and help us out. And maybe somebody that wants to transition this long term and help me stabilize.
Got it. Makes sense. And you mentioned too, we talked about your technology approach with the companies that you work with. Curious if there's any things that you look for pre-acquisition in a company that you might be looking to bring on. If there's any technology characteristics that are kind of maybe table stakes for you, or that just make a company a more attractive potential acquisition.
Yeah, I will say that the interesting thing that I've seen over the last couple of years is the prevalence of software as a service technology, which didn't exist in this space functionally until the last 7 or 8 years. It just didn't exist at all. In our business, we were used to how many seat licenses do I need? What's my annual maintenance fee? Things like that for various services that we used, operating systems, the largest of that. To see software as a service come in and really offload for those companies that take advantage of that, the server maintenance, the file storage, the intricate networking and firewalls take place in situations like that. When we do an acquisition, we send in one of our CISOs, we send in a CIO, and we really dive in on technology. We view that as really the greatest risk in our acquisition landscape, is what does their technology infrastructure look like? We've found, quite honestly, that from 2 or 3 days after we send out a press release on an acquisition, the attempted fraud hits triple at the acquisition companies. So understanding the landscape that they're in and being ready day one to put better security measures in place if they need to be in place, and secure any data that they have sitting there, is really important to us. So for those companies taking advantage of software as a service technology and outsourcing a lot of that, they're in the cloud, they're using Azure, or they're using various vendors in the space. That gives us a checkbox so we can at least understand and know that we're covered there, and know that that agency is stable now, stable tomorrow, and stable into the future, most likely.
Right, and we've seen those cyber attacks on the industry only increasing over time in terms of the rate there. So definitely a benefit of working with providers where you can leverage some of the security infrastructure that they have in place that would be really hard to use as just a company going it alone, setting up all of your own infrastructure. So
yep, absolutely
makes sense. And if you're talking to a company or someone who's considering an acquisition, making an acquisition in today's climate, like we said, there's a lot of interested sellers out there. How would you advise acquirers to be thinking about those available opportunities and the approach that they should take there?
It's a really interesting question, and I don't want to too much help my competition, I suppose. Kidding. But the marketplace has changed, quite honestly. I mean, we were in a seller's market last fall, and over the last 6 months, we've transitioned to maybe an even to a buyer's market. So somewhere in that, it's either an even market or a buyer's market. I have seen the multiples that are being paid in the marketplace come down a little bit. The terms of payment have changed a little bit, using a little more seller financing, things like that in the space. But the moral of the story is that if you're considering an acquisition, the most important factor in it is culture. You need to make sure there's a cultural match. I've done acquisitions over the years that looked wonderful on paper, but the cultures didn't sync up, and then watched attrition just bleed away the company that was acquired. And that is a real struggle. Get to know your partners, both sides of the fence. This is really about a marriage, and that when you're sitting down and talking, you're dating, and when you sign a letter of intent, now you're engaged, and when you're in due diligence, you're walking closer and closer down the aisle. The most important thing in due diligence, and maybe up there with IT security, is culture, and saying, do I want to be married to these people?
Right. That's a great point. And does this vary depending on what type of buyer you're working with? I know there's different interested parties out in the market right now.
Mm-hmm.
How have you seen those approaches vary between the different types of interested entities?
I'll steal a quote from the CFO of our underwriter, First National Title, Brent Shear, who says that there's really 4 types of buyers in the marketplace. And the longer I've been in it now, I kind of see this. You've got the underwriters in the space, where the big 4 are always going to be buying to some extent. Some do a little more behind the scenes. Some are a little more out front with it. You see right now 1 or 2 of them are very active in the space. And acquiring title agencies as part of their growth plan. Their long-term plan, whether they do it now or not, is generally change the name, affiliate into the brand, and that's important for what they're doing. So they look at it. They have to make sure that the company that they're buying fits their culture long-term, because they're becoming part of that big 4 company. Secondarily, you got private equity. That's really, I never thought I'd see private equity in the title insurance space. The returns are inconsistent. You have big highs and really deep lows, and you kind of have to view the industry over a long term. And predicting when to sell is sometimes difficult. And private equity needs to understand their sell point. They have to. But that's the second type of buyer in the space, and they're going to be really focused on driving profits, and that could mean good or bad things for your staff and for your company in the short term. There is what Brett calls the Doctor's Investment Club, which is a group of people who just have cash and want to put it into something that earns more than a passbook savings account. And title companies generally do that. Even at downsides, they generally do that. So the bottom, they don't know anything about our business really, and they can be kind of silly investors and whatnot. And I've seen a little bit of that, although some of that's gone away. And then fourth are companies like us that are title people, that are title agency people. And there's a few buyers out there like us, and we all have a little bit different models. Some change names and move you into different software systems. Others like us kind of leave most of the company alone and try and collectively move the ball forward year over year. But we tend to take a longer term approach. There's not really an end game in sight. When we pro forma out a deal, we look over 3 and 5 and 7 years. We also pro forma out over 20 because there's no end game strategy. It's really just to try and be a better company and to run really good businesses.
Right. That's a great approach. And so you have this strategy where you have that long-term view. You're bringing companies under the Shaddock umbrella. Mm-hmm. I know a big part of that, a big part of integrating one of those new companies is the customs and regulations that can differ from state to state and all the different markets that you're in, which I imagine is a big challenge there. So can you talk a little bit about how you take that challenge into consideration when you're building out that acquisition strategy too?
Yeah, so first and foremost, we make sure that they're compliant locally with whatever laws and customs they need to be complying with. This is a situation where we've been greatly helped by our strategy of leaving local. Do you understand what you need to comply with? Can you show me current compliance? Okay, great. We're going to keep up current compliance. We do utilize a software as a service company to store all of that and to keep all of our company-wide documents and licensing and all that up to date with particular systems internally to make sure we're keeping up on that. And we use a corporation to make sure all of our filings are done and all that. But it's a big challenge, but our strategy has kept that in check. For some of the larger companies that are doing quote unquote national or super regional growth. They're licensed in 30 plus states, and they need to build a massive infrastructure to understand that they're licensing and to keep up with changing regulation. For us, if a regulation changes in Utah, my company in Utah is going to know first, and they're going to implement it.
Do you leave that compliance kind of up to, is it the responsibility of each company, or do you have kind of a shared layer across companies at that compliance level?
We've got a vice president of risk management and compliance, Matt McBride, who kind of oversees that for all of our brands, generally speaking. But a lot of the implementation happens locally. So he's kind of overseeing making sure that everything is kept in check and that we know what we're supposed to be doing, and then the local companies enact it.
That makes sense.
Yeah.
And when you think about the size of a given market that a company is in, is there a different approach when you look at a company in a major metro market versus smaller regions, or is it kind of a standard approach with all the companies that you work with?
I missed the first part of your question. You cut out, unfortunately. So what was that? The first part again?
Oh yeah, when you're thinking about the size of the market, if a company's operating in a larger metro market versus maybe a smaller region, are there any variations in the compliance approach there, or is it pretty standard across companies, given that you have that?
Yeah, I mean, it can be vastly different. I mean, if you're dealing with a large company in San Francisco, California, the regulatory landscape is going to be much different than Dallas, Texas, or Orlando, Florida. So knowing that you need to sometimes work your regulation from literal city or borough all the way through state and federal it can be honestly time-consuming and mind-numbing at the same time. But that's all part of a good due diligence process if you're acquiring, understanding what you're doing in that marketplace and what needs to be complied with long-term. And versus a smaller market, you know, we do a lot of acquisition in Texas underneath our major brand there. And for the most part, we understand that so well, and there's really not much that's you know, county by county there. We don't have to focus on that quite as much, just kind of old hat.
Right. So it's really about knowing where the regulations are coming from and making sure you check all the boxes.
Yep.
And we touched on some of this, but if a business is looking to integrate newly acquired title companies into their operations, any other advice that you'd give to those businesses on the integrations or maybe some common pitfalls to avoid there too?
It is, so if you are acquiring and you're looking to fold in and looking to you know, bring in new software systems, new HR, new IT, I think the most important thing to do is understand that those employees came in that day with an expectation of job security, that they knew what their job was, they were going to come in, they were going to do it, and they were going to go home, and they were going to be able to take care of their family. And when their company is acquired, it doesn't matter who you are, but when their company is acquired, they lose some sense of that security, whether real or not. Now their job is different. They're working on a different system. Their health insurance may be changing. Their company name may be changing. How they log into their email may be changing. Their email itself may be changing. And I think that when you come in that first day, my only goal is to say that I know there's a lot of change. You don't have to trust me today. I just want you to go home with the same feeling of security that you had coming in today. So it's a time for empathy. It's a time to make sure that that you are outwardly caring for people. That is the biggest piece of advice I can give in that situation.
That's great advice. And like you said at the beginning, change is hard, and think addressing that, I'm sure goes a long way.
Yeah.
Any big things that you try and avoid, or that you advise companies to avoid when folding in a company, or common pitfalls that you've seen in the past?
Don't assume you can fix something that is broken. You may be able to, but don't assume it. You go in and understand the limitations that you have as an organization, and that there may be things that are certainly fixable, but you don't have the time, ability, or resources to fix. And if your model is M&A or is going to be part of it, buying something that needs fixing that you don't have the resources to fix will slow you down and will change your game plan.
Right. So it's worth it to pay for a quality business that has a lot of
Absolutely.
Yep.
Yeah.
We're there.
Yeah.
Awesome. Well, to kind of close out our discussion, Mike, if we can take out the proverbial crystal ball, what do you think is the biggest threat and the biggest opportunity for large title entities looking out over the next 5 years here?
Goodness, I think I said earlier that I can maybe predict out 6 weeks, and that 3 years is a stretch and 5 years is basically impossible. But I'll do my best and run the tape back, if you will, and let me know how I did down the road. The biggest opportunity that I see in the space is also probably the greatest threat. It is consolidation. Consolidation is here. It's been here for a long time. You see companies like us consolidating. You see the big four consolidating business. That kind of merger endgame strategy is in our business cycle and is here to stay. In that, you see this in various industries. The mergers and the consolidation start out small, and then it snowballs, and then private equity comes in and they build more value, and then they sell, and it slowly consolidates the industry. There will be winners and there will be losers in that, and we don't always get to pick who is who. And sitting here today, I don't know that I could predict who is who, but there's going to be a lot of opportunities in this space for local entities of all sizes to be acquired, to acquire, to move up and kind of advance their place, if you will. Jump in if you're thinking about it being on a highway, there will be some that will jump into the left lane and they'll pass other companies here for a while. There will be others who say, you know what, it's time to exit. I'm going to go right. Right. So keeping your head up, understanding where you want to go, and watching this ever-changing marketplace, and understanding where your opportunity is either to exit or to jump in the passing lane here. You can succeed or fail at both of those. That's why I'll say it's an opportunity or a threat. But I think that we'll see massive consolidation over the next 5 years.
Right. Well, sound advice to end on. Know where you're headed and what your goals are.
Mm-hmm.
So I'll wrap up my questions with that, and then we had a couple of questions come in from the attendees too. So
great.
I'll jump into some of those. So one is it's a good one. How do you find someone who can appraise an entity with a plant? Assuming kind of looking for an independent valuation there. I'm curious if Shaddock does this as well, or if you work with any independent parties who do those valuations.
Yeah, plant assets are hard. There's a couple of different groups out there that can do it. And really, to me, the question is the plant. There are some places where the plant is an added value. It saves you some time. It saves you some effort having your own plant. There are other places where a plant, you literally can't operate without a plant. So there's a difference between Portland, Oregon, there's a $8 to $10 million investment for the plant there, or Champaign, Illinois, where having a plant is just a really nice thing. So we do work with a group in Texas. If any of the viewers want to reach out to me, I'll happily share it and get it to you after the fact, because I don't have the name on me right now. But there is a group in Texas that we use for those valuations. I know there's also another one up in the Pacific Northwest that helps out with this. It can give you a real valuation on a plant and what it means to the business in the marketplace.
Great. So the answer there is get in touch with Mike.
Happy to help.
Perfect. And then next question is, are there loans, pretty sure this is business loans, are there loans available for purchase expansion if a company is looking to get more into the purchase side and change up their business mix?
Yeah, I mean, so we don't use debt that often in our companies for acquisition purposes, but there is certainly debt available. I would say have a real good relationship with your bank and with your banker. The good news is title companies, we do send a lot of money through a lot of different banks, and if you're a good customer, your bank will most likely look at a business loan or a business acquisition opportunity. Don't go into it thinking you're going to get 100% financing. You are probably not, unless you are a person of great means and you are willing to put up your great means. So you're not going to find that often. In which case, maybe you don't need that loan anyway. So,
Right.
But yeah, absolutely do that. There may be also other financing sources, but I would say start with your local bank that you probably have a very good relationship with and you're a big customer of.
Yep, that's definitely a good place to start.
Mm-hmm.
Well, as we're running down on time here, if you asked a question that we didn't get to, we'll follow up directly with you on an answer there. But really appreciate everyone attending and joining us today. And Mike, thanks for coming on, and it was great chatting with you, and really appreciate you spending some time with us.
Thanks so much, Max. I always enjoy talking with you. This was really fun.
Good to hear. All right, take care, everyone.
Thanks.